The UAE Federal Decree Law on Taxation of Corporations and Businesses prescribe 6 different transfer pricing methods to determine arm's length price of transactions between related parties. Out of those 6 transfer pricing methods, we need to select any one particular method to work out the arm's length price of any particular specific transaction between related parties. So it is necessary for us to identify which particular transfer pricing method out of the 6 prescribed methods would be the most reliable or the most appropriate for a given particular transaction between the related parties. In this presentation, we will see how to select the most reliable transfer pricing method. Here are the 6 transfer pricing methods prescribed under Article 34.3 of the UAE Federal Decree Law on Taxation of Corporations and Businesses. The first transfer pricing method is CUP, Comparable Uncontrolled Price Method. The second is RPM, Resale Price Method. The third is Cost Plus Method. Fourth is Profit Split Method. The next method is Transactional Net Margin Method. And the sixth or the last method is Other Method. We will discuss each of these 6 methods one by one in a brief manner. First, we come to CUP. CUP stands for Comparable Uncontrolled Price. This means that if any data is available to you in public domain of transaction involving similar products as exchanged in the transaction between the related parties, then you can take that price as the arm's length price of the transaction at hand. However, in practice, it is very difficult and very rare to find transaction involving the same product in the open market. However, in commodity transaction, this may be possible. Here is a commodity transaction. This is a transaction between related parties, and we have to determine the arm's length price, which we have to put on the invoice. And here are the codes of the same product, commodity product, available on commodity exchanges like Dubai Gold and Commodity Exchange, New York Mercantile Exchange, London Metal Exchange, Chicago Board of Trade, etc. So these codes can be taken as comparable uncontrolled price. And the average or median of these codes can be taken as the transfer price at arm's length price and can be put on the invoice between the transaction occurring between 2 related parties. That is how we can use CUP. The second method is resale price method. Here, we find a set of comparable enterprises from the transfer pricing database like Amadeus Global, TP Catalyst, Royalty Stat, Oribus, etc. And we find the gross profit earned by those comparables. They are called uncontrolled comparables. And we compare the gross profit earned by the related party, which is chosen as the tested party. Out of the 2 or more related parties participating in the transaction, we have to select one related party as the tested party, whose gross profit will be tested against the gross profit of uncontrolled comparables. This is how resale price method is applied. This method is appropriate where the taxable person or the tested party imports finished goods from its related party, which are then further resold to unrelated parties or third-party customers without any value addition. In such a case, RPM, resale price method, would be an appropriate method. Next comes the cost plus method, CPM. Here, the tested party out of two or more related parties participating in the controlled transaction, that tested party is either a service provider or a low-risk manufacturer. In such a case, we can apply cost plus method. I've explained this. Then we have transactional net margin method. Here, instead of gross profit or gross markup, which is used in cost plus method and resale price method, in TNMM, we use net profit margin. Say net operating profit over sales, net operating profit over costs, net operating profit over assets, etc. So where we don't have data of price to apply CUP or price of gross margin or gross markup to apply RPM or CPM, we can apply transactional net margin method because in most of the cases, the data of net profit earned by uncontrolled comparable enterprises is available in transfer pricing databases. Then we next have profit split method. Profit split method is used in specific cases of highly integrated transactions. See here, a lot of transactions are going on simultaneously. Services, sales, purchases, licensing of intellectual property, etc. between related parties. In such highly integrated transactions, profit split method is an appropriate method. Here is another example. Here, the first manufacturer, related party 1, purchases raw material from third parties and it manufactures semi-finished or intermediate goods and supplies those goods to the second manufacturer, the related party 2. The second manufacturer then produces finished goods and sells those goods to third-party customers. So here also both the related parties are participating in a highly integrated transaction. So profit split method is an appropriate method. Another case or another situation where profit split method can be applied is both the related parties contribute valuable intangibles. Here related party 1, say it is a manufacturer located in China. It employs or deploys valuable manufacturing intangible like manufacturing technology to manufacture goods like fast-moving consumer goods, automobiles, etc., and then sells those goods to the UAE related party. And the UAE related party deploys or makes use of valuable marketing intangibles like brand name, logo, trademark, etc. Here, both the parties contribute in the form of valuable intangibles. So again, profit split method would be an appropriate method. Sixth method. The UAE Federal Decree Law says that if none of the foregoing 5 methods can be applied to determine the arm's length price, then the sixth method or the other method can be applied. Article 3.4 of the Federal Decree Law prescribes this other method. The other method can be used in these cases, say unique transactions such as transfer of intangibles, transfers of businesses between related parties, sale of fixed assets like machinery, transfer of unlisted shares, long-term buying and selling arrangements, cost contribution arrangements or cost sharing arrangements where one related party incurs cost to develop infrastructure or to do R&D and other related parties share the cost. Guarantees provided and received to borrow loans from financial institutions. For these kind of transactions, we will not be able to apply the first 5 methods, and so we will have to apply the other method. These kind of data can be used to apply the other method, valuation report of tangible assets as well as intangible assets, commodity market quoted prices of imported or exported commodities, tender documents or bid documents, then documents related to negotiations between the related parties, then statistical average prices or standard rate cards set as a reference value by the national business or commerce associations. So these types of data can be used to apply the other method. Now we come to the issue, out of all these 6 methods, which method can be applied as the most reliable method to determine the arm's length price of any particular transaction between the related parties. For that, Article 34.3 of the UAE Federal Decree Law on Taxation of Corporations and Businesses provides us this guidance. First, we have to consider the contractual terms of the transaction or arrangement. Second, the characteristics of the transaction or arrangement. What are the characteristics? Is it sale? Is it purchase? Is it giving of loan? Is it licensing of intellectual property, etc.? The economic circumstances in which the transaction or arrangement is conducted, the functions performed, the assets employed, and risks assumed by the related parties entering into the transaction or arrangement. This is important. This is called FAR, Function, Asset and Risk Analysis. We have to take into account FAR of related parties participating in the transaction, as well as the FAR of the uncontrolled comparables, which we find in the transfer pricing databases. And when the FAR profile of the uncontrolled comparables is similar to the FAR profile of the related party or the tested party, only then we can apply a particular method. The business strategies employed by the related parties entering into the transaction or arrangement. So these factors must be taken into account by us to choose one particular method as the most reliable method to determine the arm's length price of any particular transaction happening between 2 or more related parties. Normally in practice, what happens is that CUP is the best and most direct method, but data of price of similar products is rarely available. So we are not able to apply CUP in most of the cases, except in cases involving sale or purchase of commodity products, where we can use the commodity price codes on commodity exchanges as the CUP. If data of the price of similar products is not available, we can apply RPM or CPM depending on the nature of transaction, if the data of gross profit or gross markup is available. If data of gross profit or gross markup is also not available, we have no choice but to move over to the transactional net margin method, because in most of the cases, data of net profit is available. After that, profit split method can be applied in special circumstances like highly integrated transactions, or where both the related parties make valuable contributions to the transaction, etc. And other method, as I discussed earlier, can be applied in certain other uncommon transactions. And remember that internal data is preferable over external data. What is meant by internal data? If the same related parties enter into similar transaction with other third parties, then the price or the gross profit margin or the net profit margin of that particular transaction can be considered to apply CUP, RPM, CPM, or TNMM, that is internal data. And if internal data is not available because the same related party or any other entity of the same MNC group is not entering into similar transaction, then we have to find data from external databases, that is called external data. Internal data being more reliable is preferable over external data. If you have the tested party as a distributor or reseller of the products manufactured by the other related party, then you can apply CUP if data of price is available. If that data of price is not available, you can apply RPM if data of gross profit is available. And if data of gross profit is also not available, you will have to apply TNMM because data of net profit is available in most of the cases. So accordingly, you have to select the most reliable method out of these three methods based on availability of reliable data of uncontrolled comparables, reliable data of price or gross profit or net profit. In case of service providers, we can apply CUP, CPM, or TNMM, again, depending on availability of reliable data of price, gross profit margin, or net profit margin. And accordingly, we can select the most reliable method out of these three methods. For highly integrated transactions or transactions where both related parties contribute valuable intangibles, we can apply profit split method as the most reliable method. And where there are certain uncommon transactions like transfers of intangibles, transfer of businesses, sale or purchase of fixed assets, there we can apply the other method as the most reliable method. In this presentation, we saw how to select the most reliable method to determine arm's length price of a particular transaction between the related parties out of the 6 prescribed transfer pricing methods. I hope you found the presentation useful. Thank you for watching.